Hi, everyone. Welcome to Halftime 2014. This is Josh Nelson. I am the founder and CEO of Keystone Financial Services. At Keystone Financial Services, we guide our clients to achieve financial security by building trusted relationships and providing expert financial advice, exceptional service, and proactive communication. Let's get started. Today, as we always do during our market forecasts and halftime events, we'll discuss where the economy and markets have been, where we are now, and what to watch through the remainder of the year. 2014 has been a very good year for most markets, with U.S. and international companies both in positive territory, gold and bond prices rising, and overall volatility remaining very low. One of the Nelson family's favorite movies is Frozen, and that was what the U.S. economy was in Q1 of this year. Although several economic indicators pointed towards the U.S. economy slowing down to begin the year, investors are chalking that up to a bad stretch of cold weather. According to a research piece released by Bank of America, this last January was the coldest in 25 years. The first quarter of the year is particularly sensitive to weather conditions, and this year, overall activity slowed as the temperatures remained very cold. It's safe to say, given the financial market's resiliency this year, investors appear to be anticipating that the economic softness that occurred was temporary. The recent release of strong Q2 GDP numbers showed a strong pent-up demand for many goods and services from consumers and corporations alike. The Federal Reserve has continued down the path of buying fewer assets each month and is expected to no longer buy additional bonds after October. However, it's important to understand that this doesn't mean the Fed is tightening or planning to raise interest rates. The Fed is simply buying less each month, but has no intention to sell what they've already purchased at this point. The Fed has made it very clear that it will remain highly accommodative to the financial markets. Interest rates will likely remain suppressed until the Fed reverses course. However, this will not happen until economic growth has clearly improved. Even though the economy has been spotty in 2014 so far, stocks continue to rally. Corporate profits continue to improve, but most importantly, investor sentiment has increased. The Federal Reserve, despite fears of raising rates too soon, remains a tailwind for equities. Also, as the bond market continues to perform well, bond yields are so low, investors are forced to take on risk, given the unattractive dynamics of other traditionally lower-risk investments. Now let's talk about where we are today. One of the main reasons interest rates remain low and bonds continue to perform well is inflation is still very low. The Federal Reserve would like to see inflation reach 2%, but for the last several years, their measure of inflation has trended well below. Until this measure of inflation sustainably remains above 2%, expect the Fed to remain accommodative with their monetary policy. And sustainable inflation can't be achieved until Americans have larger paychecks. Although employment has improved, wages haven't increased much at all after the recession. Expectations are for this to change over the next 12 months, according to a survey of chief financial officers. But until we actually begin to see American households bringing home much more money to spend, it's hard to envision how economic growth can continue to accelerate. Home sales are a key indicator of the health of the U.S. economy. When the housing market crashed in many parts of the country in 2007 to 2009, it had a large impact on the financial crisis. Since many people had borrowed against the rising value of their homes leading up to the collapse, it caused a lot of pain to many homeowners. Unfortunately, Americans, on average, have a large amount of their net worth tied up in their homes. A rebound in the housing market, therefore, is a very positive sign for the U.S. economy. The U.S. consumer is also showing considerable strength in the automobile sector. Auto sales had an outstanding month in May, reaching an 87-month high. Strong demand for high-ticket items is typically a good sign for the health of the U.S. economy, which is driven mostly by consumer expenditures. The U.S. consumer is also showing considerable strength in the automobile sector. Auto sales had an outstanding month in May, reaching an 87-month seasonally adjusted high with 16.7 million automobiles sold. Strong demand for high-ticket items is typically a good sign for the health of the economy, which is driven mostly by consumer expenditures. Nobody is claiming the U.S. job market is outstanding, but there has been significant improvement and job growth has been better than expected. For the first time since the boom times of the late 1990s, we saw 4 consecutive months of 200,000 or more new jobs added. The unemployment rate is at 6.3%, but other estimates that include the people who have given up looking for work have it much higher. Regardless, while the job market is far from perfect, the overall momentum is good. Stocks have had a tremendous comeback from the recession of 2008 and 2009. The price-to-earnings ratio of the S&P 500 is currently around 16. The 5, 10, and 35-year average is around 13 to 14, so stocks do trade at a slightly higher than normal price tag for expected earnings. Investors are optimistic that corporate earnings growth will accelerate in order to justify these prices. Furthermore, there's not much else to invest in with bonds offering such low yields. The markets have been plagued with volatility since the last recession. Uncertainty was rampant as investors were confronted with unprecedented activity. Things have since calmed down, sending volatility indices plummeting. Now, some skeptics are saying complacency is a new risk in the markets, but you can't have it both ways. Volatility is either a risk or it's not. When people were complaining about excessive volatility in the markets post-recession, everyone hoped for exactly what we've received, a dose of calm and more normal trading behavior. Now let's discuss what we're watching for the remainder of the year. Inflation conversations and debates will likely dominate the rest of 2014. It's one of the key determinants on where the financial markets move next. If the economy begins to advance at a sustainably fast pace, say 3% or above, then inflation will likely also follow suit, resulting in bond prices moving precipitously lower and assets moving out of that space. However, if these predictions are incorrect, as the Fed believes they will be, at least for the rest of the year, then stocks could potentially disappoint and bonds could once again shine brightly. Every day, this averages out to not a lot of inflation, but disproportionately attacks the lower and middle class because the essential items, such as food, child care, health care, and college, represent a much larger percentage of their disposable income. Turmoil has hit many areas of the globe so far in 2014, disrupting the financial markets for weeks at a time. One of the most recent examples is the ISIS organization that has moved throughout Iraq and Syria, disrupting the existing government. This particular instance has roiled the global price of oil and has raised eyebrows due to the U.S. government's recent history with this region. So far, the U.S. has chosen to stay uninvolved with military conflicts overseas for the most part. However, if this were to change and the U.S. military were to enter into a sustained conflict, we would expect this to have a big impact on markets. Interestingly, the Russia-Ukraine standoff all of a sudden doesn't seem that big of a deal after the recent happenings in Iraq. This proves that much of the initial shock from geopolitical tension proves to be temporary, but it remains a risk. There certainly have been instances so far this year when financial markets were at least temporarily roiled by conflict overseas, and it remains a key area of focus for Wall Street on an everyday basis. We knew it was a matter of time before the record amount of cash on corporate balance sheets would begin to be deployed, and now, so far in 2014, we're finally seeing it happen. This has especially taken place in 2014 with mergers and acquisitions. Companies have already completed over $780 billion worth of deals this year, dwarfing the previous 6 years and already nearing the entire 2007 total of $880 billion. This has been a major source of support for stock prices so far this year and could continue to provide a tailwind into the future. And some of the largest purchasers of stocks have been the actual companies so far this year. In the first quarter of 2014 alone, companies in the S&P 500 purchased $160 billion worth of their own shares. The last 12 months, including Q2 2014, is projected to be the greatest 12 months of share buybacks ever. While corporate cash piles did finally decline from all the spending in the first half of 2014, the pile remains stacked high. This amount of dry powder could continue to provide a source of fuel for markets as companies continue to invest in companies, new projects, initiate dividends, buy back shares, and maybe even raise wages for their employees. And finally, everybody's favorite topic, politics. There are 6 seats needed by Republicans to gain control of the Senate, and early indications suggest that that might be possible. This is a big election year. There are 36 U.S. Senate elections, and should the Republicans gain control of the Senate and retain control of the House, we expect that to have a big impact on the markets. Thank you so much for your continued support and for your time today. If anyone you know, a coworker, friend, or relative would enjoy listening to this presentation, please forward it on to them, and we welcome any questions that you have at our office. Thank you.